Welcome to our deep dive into the world of investing, where understanding risk and reward is crucial for every investor. Whether you're just starting out or looking to refine your strategy, grasping these core concepts can make a significant difference in your financial journey. In this video, we'll break down what risk and reward mean, why they matter, and how you can use this knowledge to make smarter investment decisions. Let's begin by exploring the basics and setting the stage for a more confident approach to investing. Risk in investing refers to the possibility that your investment's actual returns will differ from what you expected. This could mean losing some or all of your original investment. Every investment carries some degree of risk, whether it's stocks, bonds, or real estate. Understanding the types of risks involved, such as market risk, credit risk, or liquidity risk, helps you prepare for potential ups and downs. Recognizing risk is the first step toward building a resilient investment portfolio. Reward in investing is the potential gain or return you receive from putting your money into an asset. This could come in the form of interest, dividends, or capital appreciation. The higher the potential reward, the more attractive an investment may seem. However, it's important to remember that greater rewards often come with higher risks. Balancing your desire for reward with your ability to handle risk is key to long-term investment success. One of the fundamental principles of investing is the risk-reward trade-off. This concept means that to achieve higher returns, you generally have to accept higher risks. Conversely, investments with lower risk typically offer lower potential returns. Understanding this trade-off helps you set realistic expectations and choose investments that align with your financial goals and comfort level. Let's look at how this plays out in real-world scenarios. There are several types of risks investors should be aware of. Market risk involves the possibility of losses due to overall market movements. Credit risk is the chance that a borrower will default on their obligations. Liquidity risk refers to how easily you can buy or sell an investment without affecting its price. Each type of risk can impact your investments differently, so understanding them is essential for effective risk management. Market risk, also known as systematic risk, affects all investments in the market. Factors like economic downturns, political instability, or global events can cause prices to fluctuate. While you can't eliminate market risk, you can manage it by diversifying your portfolio and staying informed about market trends. Being aware of market risk helps you prepare for inevitable ups and downs in your investment journey. Credit risk is particularly relevant for bond investors. It's the risk that the issuer of a bond may fail to make interest payments or repay the principal. Companies or governments with lower credit ratings typically offer higher yields to compensate for this risk. Assessing credit risk involves looking at credit ratings and the financial health of issuers before investing. This helps you make more informed decisions and avoid unnecessary losses. Liquidity risk refers to how quickly and easily you can convert an investment into cash without significantly affecting its price. Some assets, like stocks of large companies, are highly liquid, while others, such as real estate or small-cap stocks, may be harder to sell quickly. Understanding liquidity risk helps you plan for emergencies and avoid being forced to sell at a loss when you need cash. Diversification is one of the most effective ways to manage risk in your investment portfolio. By spreading your investments across different asset classes, industries, and geographic regions, you reduce the impact of any single investment's poor performance. Diversification doesn't eliminate risk entirely, but it can help smooth out returns and protect your portfolio from major losses. Asset allocation involves deciding how to divide your investments among different asset categories, such as stocks, bonds, and cash. The right mix depends on your risk tolerance, investment goals, and time horizon. A well-balanced asset allocation can help you achieve your objectives while managing risk. Regularly reviewing and adjusting your allocation ensures your portfolio stays aligned with your needs. Risk tolerance is your ability and willingness to endure fluctuations in the value of your investments. It's influenced by factors like your financial situation, investment goals, and emotional comfort with risk. Knowing your risk tolerance helps you choose investments that fit your personality and financial plan, reducing the likelihood of making impulsive decisions during market volatility. Short-term investments are typically held for less than a year and may offer lower risk but also lower returns. Long-term investments, on the other hand, are held for several years and have the potential for higher returns, but they also come with greater risk. Understanding the differences between these approaches helps you choose the right strategy for your financial goals and risk appetite. Your investment time horizon is the length of time you expect to hold an investment before needing the money. A longer time horizon allows you to take on more risk, as you have more time to recover from market downturns. Conversely, a shorter time horizon may require a more conservative approach. Matching your investments to your time horizon is a key part of managing risk and reward. Stocks are known for their potential to deliver high returns, but they also come with significant risk. Prices can fluctuate widely due to company performance, economic conditions, and market sentiment. While stocks can be a powerful tool for building wealth over time, it's important to be prepared for volatility and to invest with a long-term perspective. Bonds are generally considered less risky than stocks, but they still carry risks such as interest rate changes and credit risk. While bonds typically offer lower returns, they can provide steady income and help balance the risk in your portfolio. Understanding the different types of bonds and their risk profiles helps you make informed investment choices. Real estate can be a valuable addition to your investment portfolio, offering the potential for income and appreciation. However, it also comes with risks such as market fluctuations, property management challenges, and liquidity concerns. Carefully evaluating the risks and rewards of real estate helps you decide if it's the right fit for your investment strategy. Mutual funds and exchange-traded funds (ETFs) allow you to invest in a diversified portfolio managed by professionals. These funds can help reduce risk through diversification, but they still carry market risk and management fees. Understanding how mutual funds and ETFs work helps you decide if they align with your investment goals and risk tolerance. Alternative investments include assets like commodities, private equity, and hedge funds. These can offer unique opportunities for diversification and higher returns, but they often come with higher risk, less liquidity, and greater complexity. Before investing in alternatives, it's important to understand their unique risk and reward profiles and how they fit into your overall strategy. Measuring the performance of your investments is essential for understanding whether you're achieving your financial goals. Look at both the returns you've earned and the risks you've taken to get them. Comparing your performance to relevant benchmarks can help you assess whether your strategy is working or needs adjustment. Benchmarks are standards against which you can measure the performance of your investments. Common benchmarks include major stock indexes or bond indexes. Using benchmarks helps you determine if your investments are performing as expected and whether you're being adequately rewarded for the risks you're taking. Risk-adjusted return is a measure that considers both the return you earn and the risk you take to achieve it. Tools like the Sharpe ratio help investors compare investments on a level playing field. Focusing on risk-adjusted returns ensures you're not just chasing high returns, but also managing risk effectively. Human psychology plays a big role in investment decisions. Behavioral biases like fear, greed, and overconfidence can lead to poor choices and increased risk. Being aware of these biases helps you make more rational decisions and stick to your investment plan, even during turbulent times. Compounding is the process where your investment earnings generate their own earnings over time. This powerful effect can significantly increase your wealth, especially when you reinvest returns and stay invested for the long term. Understanding compounding helps you appreciate the value of patience and consistency in investing. Inflation erodes the purchasing power of your money over time, which is a key risk for investors. Investments that don't keep pace with inflation can lose value in real terms. Choosing assets that have the potential to outpace inflation, such as stocks or real estate, can help protect your wealth. Interest rates have a major impact on investment returns. When rates rise, bond prices typically fall and borrowing costs increase. Conversely, lower rates can boost stock prices and make borrowing cheaper. Understanding how interest rates affect different investments helps you anticipate changes and adjust your strategy accordingly. Emotional reactions to market movements can lead to impulsive decisions, such as panic selling during downturns or chasing hot investments. Developing a disciplined investment approach and sticking to your plan helps you avoid costly mistakes and manage risk more effectively. Setting realistic expectations for investment returns and risk is essential for long-term success. Understand that markets can be unpredictable and there will be periods of both gains and losses. By maintaining a balanced perspective, you can stay focused on your goals and avoid disappointment. Working with a financial advisor can help you navigate the complexities of investing. Advisors can provide personalized guidance, help you assess your risk tolerance, and develop a strategy tailored to your needs. While not everyone needs an advisor, professional advice can be especially valuable for complex situations or large portfolios. Keeping up with financial news, market trends, and economic indicators helps you make informed investment decisions. Staying educated empowers you to adapt your strategy as conditions change and to recognize new opportunities and risks as they arise. Regularly reviewing your investment portfolio ensures it remains aligned with your goals and risk tolerance. Life changes, market movements, and evolving objectives may require you to rebalance your holdings. Making adjustments as needed helps you stay on track for long-term success. Every investor makes mistakes at some point. The key is to learn from them and use those lessons to improve your strategy. Reflecting on past decisions, both good and bad, helps you become a more disciplined and successful investor over time. Taxes can significantly affect your investment returns. Understanding how different investments are taxed, such as capital gains or dividends, allows you to plan more effectively and maximize your after-tax returns. Tax-efficient investing is an important part of managing risk and reward. Investing in international markets can offer diversification and growth opportunities, but it also introduces risks like currency fluctuations, political instability, and different regulations. Understanding these risks helps you make informed decisions about adding global investments to your portfolio. Ethical and social investing involves choosing investments that align with your values, such as environmental sustainability or social responsibility. While these investments can offer both financial and personal rewards, it's important to assess their risk and return characteristics just like any other investment. Insurance can play a role in managing investment risk by protecting against unexpected events. Products like life insurance or annuities can provide financial security and peace of mind. Understanding how insurance fits into your overall financial plan helps you manage risk more effectively. Maintaining an emergency fund is a key part of managing investment risk. Having cash set aside for unexpected expenses allows you to avoid selling investments at a loss during tough times. An emergency fund provides a safety net and supports your long-term investment strategy. Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach can help reduce the impact of market volatility and lower the average cost of your investments over time. It's a disciplined way to build wealth and manage risk. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. Over time, some investments may grow faster than others, causing your portfolio to drift from its original mix. Regular rebalancing helps you manage risk and stay aligned with your investment goals. Volatility refers to the degree of variation in investment prices over time. High volatility means prices can change rapidly, while low volatility indicates more stable prices. Understanding volatility helps you set realistic expectations and choose investments that match your comfort level with risk. There are various tools and techniques available to help manage investment risk, such as stop-loss orders, hedging strategies, and diversification. Using these tools wisely can help protect your portfolio from significant losses and keep you on track toward your financial goals. Avoiding investment altogether can also be risky, as it may result in missed opportunities for growth and the erosion of your savings due to inflation. Taking calculated risks and investing wisely is often necessary to achieve long-term financial security. Building confidence as an investor comes from education, experience, and a clear understanding of your goals and risk tolerance. Over time, you'll become more comfortable making investment decisions and navigating market ups and downs. The investment landscape is always evolving, with new opportunities and risks emerging regularly. Staying flexible and willing to adapt your strategy as needed helps you stay ahead and make the most of changing conditions. Understanding the balance between risk and reward is at the heart of successful investing. By learning about different types of risk, evaluating potential rewards, and using strategies to manage both, you can build a portfolio that supports your financial goals and gives you peace of mind. As you continue your investment journey, remember that risk and reward go hand in hand. Stay informed, review your strategy regularly, and don't be afraid to seek advice when needed. With a thoughtful approach, you can navigate the complexities of investing and work toward achieving your financial dreams.